In early March 2022, Amazon investors certainly had something to party about when the e-commerce giant announced the 20-for-1 split, its first time since the dot-com boom. In our video today, Amazon's stock split is explained, as well as how and why you should buy AMZN stock today. Amazon's first split happened in the late 1990s when it successfully executed 3 splits. The 2-for-1 split happened when shares were about $86 apiece, and the company has grown since then. Before the split, stocks were valued at $2,933. Firms that split are characterized by good earnings and have been financially successful over time, and that is why Amazon stocks got as high as they did. If you were an investor who held 10 shares of Amazon before the split, you would have currently held 20 worth $43 each. As shares soared, investors speculated about a potential split, so when the company announced, it gathered everyone's attention. A stock split doesn't necessarily change anything significant. It is just like having a whole of a product or item and dividing it into smaller pieces. The difference is that since the total has been divided, it brings down the price of each share accordingly, with the market value remains the same. Take a loaf of bread for instance to represent the whole stock. Dividing the bread into smaller pieces so everyone could get a piece at a much lesser price than purchasing the entire loaf itself is what the stock split is all about. Why then do companies like Amazon make this move, and who is likely to benefit the most? Let's find out in a bit. Even as we proceed in the video, note that this is for informational purposes only and does not constitute financial advice. Ensure to do your own research before investing. The leap in Amazon's stock price in the latter part of July corresponded with its quarterly results, as investors were reassured of the company's long-term strength. One of the ways to critically assess the impact of a stock split is to observe it in the long term, and since investors were convinced based on the company's balance sheets and reports over the years, it is no surprise that they quickly made the jump. A stock split is needed when shares in a company become too expensive. Let's go back to our loaf of bread analogy again. If a loaf goes for $100, then dividing it into 10 smaller pieces means that people who can afford to buy a piece for $2 or $3, making it more open to customers who do not have the $100 purchasing power. It is the same with splitting stocks. Prices are subsequently reduced so that investors who do not have thousands of dollars can still have shares in the company. Current shareholders in the company will also hold twice the shares of half the value for each. High-priced stocks may split enough to get their share price below $100, so they can be accessible to smaller investors trying to stay diversified. Stock splits tend to make you feel a little richer, but what are the long-term effects of splitting stocks? Tell us what you think in the comment section below. We'll get into all the details soon. One other reason why a company may lower its share prices is that it allows it to become part of the Dow Jones Industrial Average.
If the company is able to get into, and some of the other tech companies that are trying to throw their hat into the ring towards getting into the Dow Jones Industrial Average, this a very concerted bid that we've seen, really initiated by some of the most recent stock splits that have taken place this year, or are set to take place. Amazon, one of them, of course, Google, another massive one that we had heard from earlier this year too.
Because the Dow is price-weighted, stocks occupying the top spot in the index are the highest priced. Stocks that are too expensive cannot be included. So much is happening in the stock industry today. Make sure you subscribe to this channel. Let's bring you all the info you need. The problem with stock splits is that you need to figure out their long-term impact. Some investors may see it as a bullish sign for the company, and prices may rise over time. For Amazon, however, post-split performance hasn't been so great. The stock slipped 20%, and high inflation has weighed on its earnings over the last quarter. Amazon shareholders learned the hard way that the stock split was, in fact, a distraction from how the business performed and investor sentiment on its operations. Amazon Web Services also grew more slowly than expected in the third quarter, and it is quite obvious that the macroeconomic situation is negatively impacting AWS clients.
Amazing.
It is also possible that sales will continue to slow down, since inflationary pressures aren't over. With that said, however, Amazon has what it takes to handle the challenging times. The company says it is helping its customers turn fixed expenses into variable expenses, and has the necessary tools to help clients lower their cloud computing services costs. No matter the economic environment, Amazon has been well positioned to handle weathering times. For more on the e-commerce company, check out our video titled Best Amazon Stock Trading Ideas. AMZN Stocks Investing Tips for more. Thanks for watching. We'll come your way again.